Oh, yeah, good question, please.
Question 2. Question 2. Required. Calculate the profit or loss on disposal. Barca plc bought 75% of the equity shares of Madrid plc many years ago, when the net asset of Madrid plc was 45 million naira. Barca plc measures NCI on acquisition using full goodwill method. Prior to the
Naza, do you know
disposal,
about football?
yes, I watch once in a while. Sha. Prior to disposal, prior to disposal, goodwill on acquisition was impaired by 40%. So we have the cost of the investment, fair value of Madrid net asset at acquisition, fair value of non-controlling interest at acquisition, Madrid plc net assets at disposal, sales proceeds for the entire 75% investment. All figures assumed to be correct. Required. Calculate the profit or loss on disposal.
So that is just like the first one. So we have, just like we have in the first question, we also have information about Barca buying Madrid here. So what do we do? Barca PLC. Mhm. So calculation of gain or loss on disposal to parents. How much is the gain or loss on disposal to parents? We will have disposal proceeds which is how much?
110.
110,000 less cost of investment. Cost of investment is 40,000. That means what we will have is what? 70,000. When we are now to do calculation of gain or loss on disposal to the group, that will be what? Disposal proceeds. How much? 110,000. Fair value of investment retained. How much? Nil. Then what else? We now have less parent share, which is Barker's share of net assets. And what will be their share of net assets? The net asset at date of disposal. Madrid net asset at the date of disposal is 85,000. What do we do next? We
What's
need
the point?
goodwill. We need unimpaired goodwill. But we don't have the goodwill here, so we need to calculate it ourselves. So to calculate the goodwill, we will just have what? Purchase consideration. And how much is the purchase consideration? 40,000. NCI. What did you say happened to NCI? NCI at acquisition is 14,000. Then less fair value of net asset. How much? 45 million. So that will leave us with how much? 9 million as goodwill at acquisition, abi? But they told us here that prior to disposal, goodwill on acquisition was impaired by 40%. So impairment is what? 40% of 1,900. 760.
Of 9,000.
So what would that give us?
So is it of 1,900 or of 9,000?
9,000, 9,000. So it should be 36, abi?
Yes, sir.
Okay, what do we have next?
Five
So
four.
the unimpaired goodwill is what we'll now bring here. 5-4. Then we'll less NCI share of net asset. And to get what NCI value will be, we'll come here and say NCI value at acquisition. How much is it? 14,000. Share of post-acquisition earnings should be what? 85,000 minus 45,000. That will give us how much? That will give us 40,000.
That's 40,000.
So they are only taking what? They are only entitled to four. How many percent? 25% of it as NCI. So what's their 25%?
10,000.
10,000. But don't forget, they will also share impairment because NCI is measured as proportionate share. So 25% of 1,009 will be what? So what do we have? 25% of 1,009 is what?
47.
Of 36. That is 900.
475.
Of 36, not of 19.
Oh, yeah, yeah, yeah. Sorry. Where did I see 19?
Okay. Yeah, that's 900.
So what do we have as NCI value? What's the summation? Ah,
23,100.
93 1.
20.
so what do we have? What do we have?
67,300.
64,
67 300.
67, not 6.
57 or
Yes, sir.
54.
67
67,
300.
67.
So what's the gain on disposal?
42, 700.
42 700.
So that. Is it clear? Is it clear?
Yep. Yes.
Okay. Um,
And so I wanted to ask a question earlier.
go on.
That fair value of investment, do you always mean in all circumstances, or can you
Huh?
give the figure for that?
What do you say? What do you say?
I said the fair value of investment retained. The fair value of I said fair value of investment retained. Like the first one we saw too was nil, like there was no figure for it. And this one too.
Because we have full disposal, not partial. If the disposal was partial, then we would have had figure for it. Is it clear? Do you understand? Hello?
Sir, she's no more in the class.
Okay. So okay, can we look at one more question? Let's look at question 3. Question 3 is also on food disposal. Hello? Did you just call it a time?
We
Hello?
can still do one more question. Precious will soon join.
Oh yeah, please read the question.
Yes, sir. Sir, I didn't get the answer. I was having network issues.
What was your question?
I was asking that the fair value, that fair value of investments retained. When we solved the first question, it was new, like there was no figure for it. And this second one too, there's also no figures. I'm not asking if in no cases that is like that, or it's possible to have a figure for it.
That's because both questions were full disposal.
Oh, yes.
Yes.
Okay, okay. Thank you, sir. So if it's partial or the other one, then there will be um an amount for the investment retained.
What do you say?
I said if it's for partial partial disposal, then there will be a value for the one they retained.
Yes.
Okay, thank you, sir.
All right. Oh yeah, someone should read question three, please. I just want to do this one and go sleep. If I even have my way, I'll just say the class is over. We'll continue in the next class.
John PLC acquired 75% of the equity shares of PZ Limited on 1st April 20X1 for 850,000 naira. The retained earnings of PZ Limited as at 1st April 20X1 stood at 320,000 naira. The statement of comprehensive income and statement of financial position as at 31st March 20X6 of the two companies as follows. Relevant note: on 31st March 2016, Prince sold its entire holding in PZ Limited for 1.9 million naira. No dividend were paid by either company in the period. No entries have been made in the account for the above transaction. There was no impairment of goodwill during the post-acquisition period. Assume that PZ Limited does not represent a discontinued operation. Required, prepare the consolidated financial statements. I just get it.
What's the issue?
Not necessarily. What she said.
So we'll have question three. John PLC acquiring PZ PLC 75%, NCI 25%. Date of acquisition 1 April 20X1. Date of consolidation 31 March 20X6. So what percentage did they say they dispose? They said they dispose it all, have they? So if they dispose it all, It's only the disposal information we have in there, so in the additional information. So our next topic should be net asset summary. Ordinary share capital. What's the ordinary share capital? 400 mil. Share premium 250 as at the date of consolidation. Okay, it will be, most likely be the same. Retained earnings is 870 at the date of consolidation, while the date of acquisition is 320. So what else do we have? No intergroup adjustment or anything. So what do we have? So let's do note 4. Can you guys hear me?
Yes, sir.
Yes.
So goodwill. What is goodwill? Purchase consideration. How much did they buy them for? I bought it for 850. NCI at proportionate share, most likely 25% of 1320.
Three thirty.
Huh?
330.
That
What would be the goodwill? Oh yeah,
since then,
and since
Sir,
they
the
said they have,
goodwill,
what happened to it?
is it not
that was
supposed to be
it should be
25% of
of
the
970.
970?
Ah, it should be 970.
Mm-hmm.
Oh, thank you.
I wanted
Smart
to
to me.
ask.
I told you I was already feeling sleepy. Okay, so what do we do? Note 5, NCI. What is the NCI? Value at acquisition, 242.5. Then what else? 25% of what? 350. How much?
87.5.
I don't think anything else is coming in. So what do we have in total?
330.
Notice gain or loss on disposal. Disposal proceed is how much? 1,009. Share value of investment retained, nil. Less John's share of net assets. What will be John's share of net assets? NCI at date of disposal is how much? 1320. Goodwill is how much? 122.5. Then less share of NCI. So let's NCI share of net assets. What do we do?
So that first one is supposed to be, you're supposed to write net asset, not NCI.
So NCI share of net assets is what? 330 as we have calculated, Abi. What does it give us in total?
1112.5.
So what do we have?
787.5.
Okay, okay. So group retained earnings. What do we have? John's retained earnings is how much? 1150. Share of post acquisition earnings.
262.5.
162.
262.
262.5.
Okay. Aside that, is there any other adjustments? Yes, gain on disposal.
$2,200.
Okay, having done that, I don't think we have much left. There is nothing left, sir. I can just say number 8, adjusted profits for PZ, and that will just be their profits for the period. Profits for the period 235. There will be no need for adjustment since it wasn't media disposal. So what do we do next? We consolidate.
So that's adjusted profit for the workings 8. What's there? Okay, profit for the
Adjust,
period.
yes, because we are consolidating SOPL and you have to adjust the profits for SOPL purpose.
Okay. Okay.
So
So if it was a media
here we'll be
acquisition.
consolidating it. We would have prorated it based on the post-acquisition period.
Okay,
Because
okay.
there was no adjustment here, we'll just be adding the line by line item. Revenue, how much?
5,700. The other one is 3,100.
Gross profit,
2,600.
2,600.
distribution costs. So what do we have as the PBT? PBT is what?
860.
Sir, that finance cost is 180 plus 105.
So that will give us what? 285, abi?
Yes, sir.
Number next, income tax expenses. What do we have?
So the PBT is 785.
Profits for the period. Sorry, oh. No. We did not bring the gain on the disposal here. Remember we said it will come after the PBT before we get our profit for the year. The gain on disposal was how much?
Seven
787.5.
point five.
787.5.
And income tax expenses. 140 plus 180. Oh yeah,
1252.5. 1597.5.
so we are portion the profit between the owners, abi? We will have owners of John PLC, NCI, and what will NCI take? 25% of how much? Of 235. 25% of 235 is how much? Oh yeah, oh.
58.75. 58.75.
So that means this will be 1252.5 minus 58.75. Figure
1193.75.
Wow, 41K.
I said one.
1 1.
93.75.
So this should be owners of John PLC. NCI will still share the same thing because they don't have anything in the OCI. So they will still stick to what they have, 58.75. The owners of John will now take what? 1597.5 minus 58.75. Is it clear? What does that figure give us? So
1538.75.
1538.75.
Yes.
So
Mm.
consolidated statement of financial position as at 31 March 2016. Non-current assets PPE. How much? 2001 plus 1800. No adjustment. So what do we have?
39.
3900. You cannot bring goodwill again because goodwill has been sold. Investment, it was the same as you see they bought the company that is only sitting in investment. So we leave that out. Inventory. Current assets, inventory. How much? 340 plus 280. Then receivables,
620.
250 plus 420.
670.
Then cash and bank, we have what? 460 plus 200. Plus how much did they say they sell it for? 1.9 million. And that will give us how much in total?
Two 560 for the cash and bank. 750.
Okay. Share capital. Okay. Group retained earnings is how much?
2,200.
Group retained earnings.
2200.
Sorry. Yeah, 2200. Okay, after group retained earnings, what do we have? total, then let's bring, we cannot bring NCI again because we are no longer in control. So number next, non-current liability. Wait, if we are not in control, why am I then consolidating now? I'm not supposed to consolidate.
Fine.
Oh,
I'm not to consolidate. You know,
so
they
it's
sold
just
that
liquid.
entity, that subsidiary at the end of the year. So we cannot consolidate again since they sold the entity. So we'll
Okay,
have what?
so just take only the parent figure.
Yeah, PPE should just be 2,100. Inventory 340. Receivables 250. Cash and bank 460. What's the summation for that?
3,150.
So non-current liability. What did they say? We have 5% loan notes.
Sir, for that cash on bank, are we still bringing the 1 9 or not?
We are supposed to bring it to along èmi kọ́ mo wà ní kíláàsì lálẹ́. So that means it should be 2,360. Sorry, what do you say again?
5,000. That would be 5,000. The total 5,050.
Okay. So what do we have? 5% loan notes. So trade payables. What do we have as trade payables? Current liability. What do we have? Trade payables. How much? 650. Bank overdraft. 180. Income tax payable. How much? 170. What do we have in total? You haven't even given me this one. No.
So that one is 3,350.
So you add it to other things. What do we have?
5050.
So that is that on that. As you can see, the only difference we have here, though that's because we don't have much additional information, is to show the gain on disposal in our SOPN, and for our SOFP, we've already included it in the journal listing. So that is that. Any other question for me?
Sir,
Any other
please, I
question
want to
for
ask
me?
a question. So we
Yeah.
only consolidate the SOP, we will not consolidate
What do
the
you say?
SO. Sir, can you hear me?
Yes.
Okay.
Yes, I can hear you. We are not
So we only
consolidating SOP because as at the day we are preparing it, they no longer have control. So if they don't have control, you cannot be consolidating for it. And we are consolidating the SOPL because during that period, the transactions we are representing, they were standing in the place of both Tetraco gas and Tetraco CNG. Sorry, we consolidated out of SOPL because during the year when those transactions were carried out, they were still part of the group. You know, SOPL report what transpired during the year, while SOFP report what we have at the end of the year. Is it clear now?
Yes.
Hello?
Fortunately, it's like she left. So
Hello, Ashwin. Good night, oh.
thank you, sir. Good night.